Welcome, everyone, to another edition of the Tony Sirianni podcast. Very happy to have Brandon Kawal with us, who is the partner at Advisor Growth Strategies and an expert and extremely knowledgeable in all things at financial advisor, but particularly the M&A market. So I think this is a good time to have you on, Brandon, and thanks for being on the show.
Thanks for having me, Tony. Happy to be here.
Great. So, let's kind of get into it. I mean, uh, is this the number one topic of conversation? I think it is. When RIAs get to a certain size, there starts to be a lot of conversations around, valuations and a lot of conversations around, it's natural to sort of want to know what your business that you've built is worth, right? But there's a lot of subtleties and nuances to it. We just talked you and I a little bit ago about, who has equity, who doesn't, how's the equity structured, how is the financing structured, who owns what. And there's so much to get into here, especially if you're look at the aging nature of our business. It's this trend seems like it's going to, continue to push on for, as what inning are we in? I get asked that all the time. You know what I mean? That's kind of a good question. Well, as a matter of fact, I'll ask you that question because then I'll have my answer, which is probably going to be different from yours. But what inning are we in with all this movement here?
Yeah, I think you're right. I think it is a number one topic. It's on people's minds. I think there's a lot of reasons for that, but I think the innings wise, I don't know. I'd put us fourth, fifth, maybe somewhere around there. I mean, it's not.
I used to say all the time, like 4.5, so I was like a little bit of a cop out because bef it's not the beginning of it, and it's certainly
Yeah,
not the end. You feel the pressure, right? You're seeing it so much. But what I'm kind of coming to a conclusion is that the inning, I'm asking the wrong question, right? It's not even a matter of innings. I think this is becoming the business. So I think people tend to look at it like, well, how many more guys are going to jump out of the wirehouses that we can turn into M&As? I just think that this is the business and it constantly moves. I think if you looked at M&A 10 years ago versus today, there's just so many different ways of financing these things. There's just so many, different
yeah.
modes of financing that have come in, right? I mean, so this is the business now. So I just think we're in an ongoing move where as we come up with new ways to sort of finance these things and new ways to look at equity and things like that, that it's just part of a continuum.
I agree. I think, and we've seen that over the last, really over the last 5 years, but really if you look back over the last 10 years, this industry, it went from opportunistic buyers, it's been opportunistic sellers, maybe mergers, putting practices together kind of in the early days of capital in our industry, I guess a little bit 10, 15 years ago. But I think you're right now where you fast forward to today, this is the industry. It is a foundation of the industry now to have professional buyers, to have professional investors that are going to continue to execute those business plans. And it doesn't mean that that's the inevitability for every firm that they have to buy or they
Yeah.
will have to sell to an external. But the reality is that it's now, we have lots of firms with corporate development teams that do M&A as their full-time job. You just didn't see that a decade ago, right?
Yeah, yeah.
Other than Focus maybe, who's undergoing their own shifts these days. It is very much a professional industry of buyers and sellers and professional capital providers. So I think this will be here for, I think you're right. It's probably the wrong question to ask. I think it's more of what version of this are we
Yeah,
in? And we're just in
exactly.
the early days of a much more professionalized M&A space.
So that was a trick question, but I think we handled it. We handled it pretty well.
Got through it.
So let's look at the three things I know and I'm taking stealing this from you, right? Because this is the way you like to look at the industry. I know we've sort of had this conversation before. So look from the sell side, the buy side, and then the do nothing perspective, right? That's sort of a Brandon sort of, those are Brandonisms. But let's look at it from the sell side. So an M&A mindset, you think is part of the key, well, one of the key factors for a firm.
Yeah, I
So
think
what does it mean? Yeah.
to our last conversation, I think it piggybacks right off of that, where you can't really ignore what's happening in the M&A space. When you think about, you're right, a lot of people are thinking about valuations, are thinking about how they're handling equity succession, incentivizing their key people. These are all very internal things that are, on the minds of a lot of owners in in the space, or even those that are not quite in the RA space yet. I'd say a lot of the we've done work with breakaway teams and firms setting up new RAs or for a long, long time, and that's a catalyst that's probably on their minds too. Is how do I, one, monetize and realize the value I've built, but two, what am I going to do to share it and all those different things. And the reason I bring that up is, the M&A sort of, this wasn't a boom, and now we're, a bust. It's very much here to stay. It's professional, as we mentioned. So, for firms that either want to engage in it or think they might at some point, or even I'd argue at this point, want to avoid it, you have to have this mindset of you're running your business in a professional way. It's not necessarily my practice. I show up and I, let what happens happens. Now I think it's much more, the stakes are a lot higher than that. And the example I'll give is a spinoff of the M&A theme is that, yes, professional buyers are buying, but they're also recruiting. So when you think about keeping your best talent in their seats, you have to look at what they need and what they want, because someone else will be trying to, it's everyone's LinkedIn inbox or whatever.
You've got to you've got to understand the difference between equity and enterprise value, right? So those are the two big buzzwords that everyone always gets hit with. So again, part of my trick question session with you is I look at equities sort of in a very, very large way because I think it's different for every firm. If you look at how a firm is financed, that's going to tell you what kind of equity it has. You know what I mean? And advisors are very often like the cobbler's kids, that don't have any shoes, right? They don't ask the right questions for themselves. If it was their clients, they'd be so open-minded and ask, a whole bunch of questions about it. When they join these firms, they don't understand what a waterfall is. They don't understand what the difference between a PE firm and a venture or roll up. They don't understand where they stand when the equity comes out. And I think there are other firms where they don't have an equity position, but most of those firms, and I think you got to look at things like Stifel and some other big firms that are regionals that share a lot of the same values that those guys do. They have big balance sheets. You can build your enterprise value there and they'll buy it back from you. You have your own little M&A, little M&A
Yeah.
world. You build it, you go. And so I just think that all of that's on the table for advisors. It's confusing. And it's all to do, has everything to do with recruiting.
Yeah, agreed. And I think you're absolutely right. And equity just means a lot of different things to a lot of different people. And it's funny you talk about the enterprise value, equity value. I'm going to come back to that, because I think it matters a lot more today than
It
it,
does.
used
Yeah.
to. And but I think to that point, what you're saying is there's a lot of options out there, and there's a lot of different ways that people are thinking about equity and financing and the like. And then, you have very professional teams on the buy side that are out looking for talent. You're going to see a lot more of the large, enterprise RAs, and RAs already are poaching from each other. And that's only going to intensify. So when you think about the M&A mindset, it's less about, hey, when are you going to sell? Or, it's more about what are you building? What would you sell if you were going to engage the M&A market? And, when we think about the three key drivers, growth, talent, and your sort of niche, if you will, your target market, those are the three big drivers for any firm that's going to market. It's related to your client goodwill and everything else. If you're not paying attention to that and the competitive shifts in the space, yeah, it's just going to get harder. That's all. I mean, it's not that you can't have a business and that you can't do fine. It's just going to get harder to compete, primarily because of the trends we're seeing in talent, talent getting poached, and becoming more difficult to go after the same clients as everyone else, and on and on. So
It's like it's harder to be, a one-off, firm on your own, without scale, I think, than it is the ways to find capital and the capital that's out there are so much easier today than they were. But when I started the Washington Wealth Management, I put my house in it. I mean, that was the way to finance it.
right.
This 15 years ago, and then things have moved very quickly, since then. So today financing is not as much of a it's not a problem to find, but it's a problem to find the right one.
That's
Right.
I agree. Yeah, absolutely. And I think the risk equation is just a lot different than
Yes.
it used to be. So there, and I think to your point, financing is finding the right financing. I think for founders that are out there, this notion, we're big right now. We always have been, but we're really trying to be forefront of this. So building an equity culture to your team. It's kind of like pay now or pay later. So for example, from the sell side, like firms that are thinking about engaging the market for a transaction, there are several buyers that will either one, they'll come to the table and say, we need to do something about the fact that your team's not bedded into this, right? Like somehow, some way together, or they're just going to pass on an opportunity to acquire a firm because they're not confident that the team is going to be engaged post transaction, right? That's a huge part of it for them. So as buyers are getting a little bit more selective in the space, the business building that you're doing.
Buyers are learning the hard way. I mean, so I think now there's a fair amount of ignorance among financial advisors as to how the equity thing works. In the beginning, buyers were ignorant. They were throwing money. They think, oh, I'm buying these assets. I don't think they understood that they were buying a baseball team, not a football team.
Yeah,
That the advisors can leave if they want
right.
to.
Yeah.
I don't think that was well understood as they started to put the clamps down on the guys. That was just
Yeah.
not.
Well, and we've always had restrictive covenants and those types of things, but I think to your point, you start to realize that like the carrot works sometimes a lot better than the stick, and and there's lots of questions about where regulations and law will go on a lot of those things, but so you might as well deal with it up front and say, all right, well, what sort of commitment level do we have to your point? Because people can leave, they have choice, and there's plenty of it today, as we were talking about, where a really talented advisor that's in their 30s or early 40s or whatever it is, that they're not going to have a shortage of places to go. So that's a big part of what's happening from the sell side. So that M&A mindset really just cascades like really quality business building tactics, really looking at thinking about it as your business, thinking about it about, how you're building value. And if the answer is like, hey, it values my income stream every year, that's okay. But you have to be committed and have conviction to that strategy and understand that there's trade-offs for those business decisions. So if you're dealing with it when it's broken, it's probably too late.
So also on the sell side, um, you talk about having an M&A mindset, but you should have an idea of a lot of guys don't have really good business plans. So to have an idea on where you want this business to go, that'll change maybe who you pick as a partner for this,
Yes,
right? So
agree.
like, I want to take this and I want to grow it, and then I want to build my enterprise value and like that. Or this is a succession transaction. I really want to ease out of here.
Yes. Yeah. And I want, and I think that's another critical factor from the sell side in today's market. If you think about how many buyers operate in the different models that they all try to deploy, from integrators to investors to somewhere in between, you have all different flavors out there. There's north of 40 sort of firms that we would consider serially active, right? Doing much more than a deal to two deals a year. They're doing a half dozen or more. You're That's a lot of choice. And so what ends up happening is from the sell side perspective, the business plan, to your point, is one, it's just a good practice for running your business, right? And
Yeah.
whether you're going this route or not. But two, it's a North Star, right? And it starts to cut through the noise of, who the right partner is, what the right model for you is if you're going to go through with this. M&A is real work. So it's got a lot of fancy things, valuation, otherwise to talk about multiples and all these other things. But to go through a transaction is a lot, and it's not something that you're ideally going to do more than once. So you want to make sure that you get it right. And that business plan points right to it. What are you trying to accomplish
Well,
in
that's,
that
I guess, how
transaction?
do you, as a professional in this space, you look at a firm, you have two firms side by side. Maybe this is not a fair one, but you get where I'm going. One's a lifestyle type practice, right? Doing very well, but he's happy where he is or she is. And the other one is a firm that's, maybe the exact same size and revenue, but has a plan to grow and wants to grow. And that's how do you value those firms differently? Or you
Well,
don't?
I think the honest answer is depending on where the market is. A couple years ago, they might not get valued all that differently. I
Right.
mean, they might because the market was just so hot. There'd be a little bit of difference because the reality is one probably is underinvested in their business and the other one's probably appropriately invested in their business. And so, buyers are smart to pick up on that and what they're buying. But I think now in today's market, there's two things come into play there. One, buyers might just pass because they might just say, you know what, the risk is too high. We have other options with firms that have laid some of that groundwork and want to grow and have the sort of shared mindset that we have to build value. And so that might be one. So you could lose value just from buyers not wanting to engage or politely telling you that you're not the right fit for them. And then I think the value today, what you're going to see is a lot of structure. And that's the thing that is probably not discussed as much, or as much as I'd like it to be in the space where I can tell you any multiple I want, right? And others that much more accomplished than I have used this, where it's like you tell me the price, I tell you the terms.
Right,
That
right.
that's exactly where the valuation shows up. Is I just will ask you to share risk with me because you might say you want to do these things, but what you've done to this point doesn't make me confident in it. So I'm going to make your deal structure a little bit
Doesn't,
more
but don't the
Christian.
deals work? Don't they work so much better if they grow? I mean, isn't it so much better for everybody if the
Yeah.
if the firm grows?
Yeah, well, and that's right. And I think a lot of the buyers that are having a lot of success integrating these businesses have, they're not perfect, but I think that's what they're looking for. They're out there and trying to find folks that say like, we're growing, we want to make sure you have that growth mindset. We'll certainly pay you well and incentivize you to do that. And then that's what works well together. They know it because they've done it 30, 40 times. They know which ones are going to do well and which ones excuse me won't. And that's now really driving the market. Doesn't mean there's not a market for like the business that is sort of moderately growing or maybe maintaining. It's just not the market you might think, right? It's just going to be a different market. You can't say I'm not growing and I'm not focused on the business building and I want top valuation and the least amount of risk. Those two things or those things don't go together.
Right. Well, let's talk a little. I mean, believe it or not, we're pushing some time here, but we from a buyer's perspective, what would you say are the top, considerations for them?
I think it's been this way for a while. Talent, talent, talent. I mean, I think this is still a people business as much as, we try to try to talk about all the tech and everything else. It's all wonderful and it makes people more efficient, but there's still the relationships are still what moves the needle for most. So I think the large platforms are looking for talent, they're looking for depth, they're looking for expertise, they're looking for new capabilities. So when they're looking out in the market and to acquire. Yes, you're acquiring assets but that asset is largely a human capital asset and a goodwill asset. So when you're looking at what buyers are looking for and should be considering, it's that talent, geography, services. Those are the three that
Yeah, yeah,
I think really move it.
yeah, that makes total sense. But what about what's now on the red flag side? So what should buyers? If I'm a buyer, what do I pass on? This is a hard pass. Other than the
Yeah.
guy shows up or the gal shows up drunk at the meeting, right? That's a hard pass. But what else?
Yeah. Lack of true organic, that there's going to be most of these buyers have put together very impressive organic growth machines. We could all question all day how they're doing it and if that's the right way, but the growth is there for the vast majority of them. So,
By the way, the markets have helped a lot with that.
well, and that's the thing. So you don't want to run the risk that you compound. I mean, a lot of the buyers have built true organic net of market engines. You can't add to that someone is declining or flatlining. It's hard to like change that behavior just through a transaction, right? Like we were talking about before. But I think for buyers, that should be on their minds. It's just a behavior, an execution mindset. I think the other piece of it is just lack of commitment with the team. I mean, I think that's
What
the
about
reality.
anything structurally that you would say, yeah, or even it doesn't have to be for all. It could just be for you. This I don't like this. Is there anything structurally that you wouldn't want to buy? You just would normally pass on, just not up your alley.
Yeah, I would say not necessarily with the way they run the business. I think today's market is pretty friendly to a lot of different business models. I'd say internally though, I'd get very leery of someone who doesn't have a handle on their data. That it's just, I think it connects to a broader problem of like, if you don't know what's going on in this business, and you don't have a good handle on that, I might have some questions about that. It doesn't mean I won't like the person and won't see the deal through, but my eyebrows, it raises a little red flag, like, hey, yellow flag at least that, there might be things in this business that you don't understand and I might find out. And we have seen that before where the data is kind of a mess and things that, maybe an advisor, entrepreneur that I just didn't realize was going on. It's weird to say it that way. It's just true though. They're busy out closing business and
Sure.
working with clients. There could be some things that develop there that could be problems. So look at it now. Don't wait till a buyer does diligence on you to find it.
So, finally, I just don't want to do anything. I'm happy where I am. Why is it important to stay abreast of stuff, even if I'm not ready to do something today?
Well, I would say kind of going back to what we were talking about before. I mean, the M&A market's here to stay. So the professional buyers are out there. We did our research earlier in the year and we surveyed, and I think 94% of our survey participants said they've been contacted at least once a week by a buyer or banker or somebody out, kicking the tires on this. So you just need to stay educated, I think. But it's also just informs how you would think about building your business. Today you have to be a lot more intentional about staying out of the M&A market than getting involved in it. And from the sell side, from the buy side, if you have even a thought that you want to be a buyer, you must stay abreast of what's going on in the M&A market because it's so much harder today to enter the M&A space than it was 10 years ago. It's multiples, orders of magnitude harder to enter. And it's not that you can't do it, it's that you having success in it against incumbent serial buyers that are capital backed and on and on and on. It's just a lot harder to do. So if you're not educated and you're not being pretty precise about how and why you're going to get lost in the noise, right? It's you
Yeah.
versus 40 to 50 other very, very credible buyers out there that have had a lot of track record of success. So I just think you put it all together, it just shapes competition in our space. It shapes where the industry is going. And for people who don't, it's kind of like the do nothing mentality. And I have a lot of clients that have that, and that's great. You just have to understand how it's impacting your business. For example, how are you going to recruit talent? How are you going to engage talent? Because they're getting phone calls and emails every day. And then ultimately, how are you going to serve your clients? Because these firms that are building really, really strong growth engines, whether an institution or a large RA or what have you, they're out there, they're marketing, those clients are going to hear about it at some point. So you need to make sure that your experience is in a good place, right? Otherwise, it's attrition risk on both the talent and client front. That's what you're hedging against.
Look, I think that's a good place to stop because we're not only out of time, but we can continue this discussion,
Yeah.
at some other point that was really helpful, I think, for people. So thank you for spending some time with us.
Yeah. Thanks for having me, Tony. Appreciate it.
You got it.